Good afternoon. This is Matt Carbray, Certified Financial Planner and Managing Partner at Ridgeline Financial Partners. We're excited because this is our first ever podcast. We have been trying to put something like this together for quite some time, but we're excited that we're going to be able to get a podcast out on a more regular basis. A lot of you have seen us in social media. We try and do a great job of educating our clients and those in the community about some of the different things that you should be thinking about throughout the course of the year as you start to do your own financial planning. This is an exciting time for some, and for others it's a time where maybe it's not as exciting. We have just recently filed our income taxes. What an exciting time to be alive. And what a lot of people are experiencing is the first time that you filed income taxes when we've had some new sweeping tax legislation. Now, we haven't had tax legislation that has been this significant in quite some time. And what we are hearing from a lot of our clients is that, well, geez, Matt, I don't think I ended up quite as well off as I thought that I would have ended up. Or, you know what, there were some things that we noticed that we could have maybe taken advantage of if we had done some planning a little bit earlier on in the process. So let me just go and talk about some of the different things that we are hearing from our clients. The first thing is, well, Matt, I expected to get a much more significant refund. I'm hearing all about the tax brackets changing and more of my income being taxed at a lower rate, and just in general, me being in a better position from one year to the next. And I'm getting a refund that's a lot lesser than what I got in past years. Can you help me understand how that's possible? Well, first things first, the amount of tax that you pay one year relative to another is really what you need to use as a baseline to determine, did I pay more tax or did I pay less? Not necessarily the refund that you get back. And the reason that that's important is because the amount of tax that's withheld from your pay, assuming you're a W-2 employee and you're not a self-employed individual, is a lot lesser, or has been a lot lesser, from what we've experienced in 2009 and 2018. Now, you're probably asking yourself the question, well, I didn't do anything. I didn't go to my payroll office. I didn't go to human resources. I didn't change how much tax I had withheld from my pay. Why is it that less tax was withheld? Well, as a result of the tax legislation, lesser tax was being taken out of people's pay. So the reason that your refund may have been lesser than past years could have been driven a lot by the withholding. Now, should you have noticed this in your pay by way of a higher take-home? You should have. But is it uncommon for us to kind of forget about those things over the course of the year? Yeah. Or did you possibly have higher medical expenses for the premiums that you pay? That's most certainly a possibility. So with all that being said, for you really to get an idea of how you made out from one year to the next, look at your amount of tax that was due in 2018, compare it to 2017, but also compare your incomes, right? Because your incomes are really the driver of the amount of tax that you pay. And the last rate that is most important is not the tax bracket that you are in, because what most people fail to understand is it's not that you're in the highest tax bracket and every single dollar of your income is taxed at that highest tax bracket. Your income is taxed in our marginal tax rate paradigm. Some income is taxed at 10%, and additional income gets taxed at higher rates as you move up the ladder. So that effective tax rate, effectively, what was the federal tax rate that I paid on my income, is really important. And compare that from one year to the next. And I think you'll get a better idea as to whether this tax reform was a positive for you, or whether you were one of the 5 or 10% that were on the wrong side of tax reform. Okay, second question from our audience. Matt, it's great that my taxes are done, but now I'm wondering, when is the best time to start planning for taxes? Well, that's an easy question to answer. You need to start planning for your 2019 taxes now. And the reason being is, if you are starting to think about your 2019 tax return and you're in 2020, you may have missed out on a lot of the opportunities that are available to you. If you are a resident of the state of Connecticut and you have children and you are planning for those future educational costs, which we all know can be very daunting with the rate of inflation that a lot of these educational institutions are experiencing, there are ways that you can save into a college account sponsored by the state of Connecticut, the Connecticut Higher Education Trust, and you can take advantage of a state income tax benefit regardless of what your income is. But that is something that needs to be done in a calendar year. So if we're thinking about taxes during tax time, which is all too often from February 1st to April 15th, it's too late for some of those things. Are there other things that you can be doing throughout the year with respect to your charitable contributions? Yeah, there very much so is. There are traditional ways and there are untraditional ways to give to a charity. You can very easily stroke a check to your charity of choice and feel really good about it. And there are other ways that you can gift certain types of assets, appreciated stock. If you're over the age of 70 and a half and you have those mandatory required minimum distributions from your retirement accounts and you don't have a need for the money, that's another phenomenal place that you can take that money, direct it to a qualified charity, and not have to pay any income tax. So I would say to you that there is no better time than the present. You also have time, being that we're in May, to change your withholding. So if you experienced having to pay tax when you never did before, or your refund went down significantly, there are things that you can do now over the next 8 months to adjust the amount of income tax that you have withheld. So get ahead of that. We got 8 months to go. Be proactive. Look at your returns from one year to the next and make a determination as to whether there's a need to make some of those adjustments. Your retirement plan through work. Health savings accounts. Those are certain things that are also contributed to over the course of a calendar year so that when your W-2s are processed, they will be reflective of any contributions that you've made. A reminder for the 2019 tax year. If you are a participant in a 401k or a 403b plan, the maximum amount that you can contribute if you're under the age of 50 is $19,000. If you are over the age of 50, it's $25,000. And the limits for a lot of retirement account type vehicles, IRAs and HSAs, have been adjusted accordingly. So it is a good time for you to realize what those limits are. And it's also a good time as any to realize how close you're going to be getting to those limits. And remember, those limits do not include specifically the 401k contributions that your employer makes to your retirement. So get a jump start on it. It's May, but before you know it, we're going to be having a podcast talking about tax planning, and it's going to be November or December. Okay, another question here. Matt, how do I know whether to file on my own, use a service like TurboTax, or hire a professional accountant to help me complete my tax return? That's a great question. So I will say this. There is nothing wrong with using a tax service like TurboTax. Again, this is not a commercial for TurboTax, but a majority of people who work for a company who get a W-2, maybe you get a mortgage interest statement, you get a bank account interest statement, a couple of miscellaneous brokerage account activity, it may be very easy for you to take that data and in turn put it into a software and be able to have the return done that way. If you are comfortable with doing it, you have a history of doing it, and you have a pretty good handle on your finances, it may be cheaper. Well, I know it'll be cheaper, and it'll be more timely in terms of you being able to get your return done, get it filed, and get the process of getting whatever refund you're owed. Ideally, if you're getting a refund sent back to you. If you have certain complex investments, real estate, investment properties, if you have inherited money, if you are taking distributions from an inherited account, sometimes it could get tricky. If you're making charitable contributions and you're doing it by way of giving stock or your required minimum distributions that I alluded to before, you may want to engage a professional. I will say that 9 out of 10 people probably could get by without a need for a professional, but the more evolved your situation gets, the more you have going on in your financial life, the better it sometimes is to have a professional. Case in point, client filed a tax return and the IRS came back and said, you owe a sizable tax bill because you sold a bunch of stock. What we found out was the stock that was sold, there was no cost basis reported, meaning that the IRS assumed that the investor never paid anything for the stock initially. So all of the proceeds of the sale was taxable. Well, we know that not to be the case. That individual didn't know that there was a corresponding cost basis associated with that stock transfer. If a CPA were involved, they would know to say, hey, Matt and the team at Ridgeline, Mr. and Mrs. Smith sold Apple stock, and we need to know what they paid for it originally. That was a very scary letter to receive. It eventually got sorted out, but if this person did not get in contact with us, which we in turn got in contact with a CPA to help this person out, they would have had the appearance as though they owed $30,000 in capital gains tax. So the good news and the end result of all this was that we provided the cost basis, the gain was significantly lesser than what was thought, and the tax due was also much less. So accountants provide a ton of value. I always say that I am absolutely positively not a do-it-yourselfer. I can't fix anything. My wife doesn't let me hang anything in the house. I create bigger holes. Then I got to have someone come and patch it up. And by the time all is said and done, if I were to have paid someone, it would have cost me a lot less for them to do it one time rather than to clean up my mess. So the same can be said when it comes to filing your income taxes, or for that matter, thinking about going out there and doing your own legal documents. You could go out to sites such as LegalZoom and you can have them prepare a will, a power of attorney, a healthcare proxy, or a healthcare directive, or maybe even a trust. I think they even provide those services. But if you are not, I guess, confident in your ability to put all of your intentions onto a document that's being provided to you by a direct provider, then I would say, much in the case that you should hire a CPA, you should also consider hiring an attorney. The more complex, the more involved, the more nuances of what you want to have happen with your planning, the need for an attorney becomes even that much overwhelmingly relevant. So get professional advice. Yes, sometimes it costs more, but the end result may be that you pick up all of those deductions that you were owed, you take advantage of any opportunities within the tax code, and sometimes the tax software is not going to direct you in that direction. So good luck to you if you are going to go out and do it on your own. But if you want an opinion as to whether we think you're a good candidate to do your own tax return, please let us know. We've got many great centers of influence and partners that are reputable and established CPAs that we'd be happy to refer to you as well. Okay, so wrapping up, this is our first podcast. It's in the books. We tried to keep it short and sweet. We don't want to kind of take up too much of your time. We value it as much as we want to try and provide you some information that you can in turn take with you and better position yourself for the tax season that is the endless 12 months from now to the time you're going to file your tax return in 2020. So we'd love to hear from you. We hope that you will provide questions for us in the future that we can in turn and use to shape future podcasts. We are out there on social media. We'd love to connect with you. If you want to follow us on Twitter, it's at Matt Carbray CFP. That's Matt with 2 T's and then CARBRAY CFP. We have a Facebook page on Ridgeline Financial Partners that we are very active on. And hey, our goal is to just give you a little information that you can in turn use to better your overall situation. So we thank you a ton for tuning in. We look forward to our next podcast, which we are trying to do at least on a monthly basis. The topic to be determined, but please reach out to us, give us some ideas, let us know what's important to you, what's going on in your financial life, what keeps you up at night, and we will try and shape our future podcasts based on what's important to you. So thanks again. Have a great one. That's Matt on Money.